Hello, Hello everyone. Welcome back. So today I felt like playing around with a. Hello everyone. Welcome back. So today I've been really feeling the itch to really try out a new strategy or a new challenge when it comes to Speculator. So this strategy is known as like the bond only strategy. So I found this kind of interesting because I've been wanting to really for a long time. I've been wanting to do different strategies and different challenges because that's really how you get better in life, is in my opinion, is you really challenge yourself. So my previous series, I've done stocks a lot, and I've done a mix of 50-50 where I have a balanced portfolio of stocks and bonds. And this game doesn't really teach you too much about like the whole current bond market, but it teaches you about the past bond market and how interest rates worked back then. But nowadays we're in super duper low interest rate environments. So in my opinion, a bond only strategy would actually be, I think it'll be a good idea if you want security, but preferably I would say stocks are are a little bit better in my opinion. But it's good to have some bonds. Like as an example, I bought a convertible bond, and that goes into our segment where I decided to add convertible bonds to this roster, even though they're not considered debt. But I made that decision just because convertible bonds are very interesting. So I decided to add convertible bonds because technically they're considered debt, but they're a bit of a hybrid security where you're buying a piece of debt, but you also have the ability to convert it into common shares. So therefore, this isn't really entirely debt only, but I decided to add just one type of equity, which is convertible securities. Anyways, going back into where we start. So I'm going to be Reed. So that's my name, but I'm going to name it Canadian Investor. That's my IRL name is Reed, so it's pretty interesting. That's what my channel was named previously, but I decided to rebrand my channel into the Canadian Investor, so I find that kind of interesting. We're going to start off with $100,000 USD. I know that sounds like a lot, but personally I think it's achievable. It's just a bit of a challenge. Like I'm currently trying to hit $100,000 Canadian, and it's a little bit of a challenge, but I think once you hit $100,000, that's when your money really starts working for you, because let's just say for a hypothetical, you have $100,000 invested and you make a 5% return. So we use 0 to 0.5. You're going to make about $5,000 a year, and that $5,000 a year is going to be able to buy more stock and then compound at a much faster rate. Whereas right now, I think I'm at like almost 50,000. So if I make a 5% return on my portfolio, this is income from dividends, I make about $2,500. So I'm definitely not making that much. I'm making almost like $1,300 a year. So I'm not making a 5% return right now. But that's just a hypothetical. Anyways, starting off, none of this is really to be taken as financial advice. I'm just doing it for entertainment purposes. I'm just mainly doing this because I feel like it would be a good little challenge for me to learn a bit more about bonds and maybe to share some insights and everything else. But I would say do your own research before you make your own financial decisions, because I don't understand you as much. But I think it'll be interesting if I teach you a few things that you can apply to your toolbox. Anyways, so now we're going to start off 100,000. We're going to do 30 years, and we're going to do difficulty 1. I was considering doing difficulty 2, which includes taxes and stuff. So I'm not sure if I should add that or not. It might be a little bit more challenging. I could do difficulty 3, but I think that would be not very helpful. I might do 2, but 2 I would have to consider a lot of taxes and stuff. And in the game, capital gains is the most efficient. It's kind of like in Canada. So if I were to get out a where's my notepad? So when it comes to Canada, especially in Canada, we have 3 different sources of income you can receive out there, and this would be in ranges. I think the music is a little bit too loud. My bad. So this is ranges of the most effective. So the most effective sources of income out there go by this. So you got your capital gains, aka like your profit. So in this case, this is your most effective taxable thing. And you get your second most effective, which would be dividends. And then your least effective would be interest. So as a hypothetical, if you max out your TFSA and you're going to be doing taxable investing, and if you're in a high MTR, marginal tax bracket, basically means that you're making a lot of money a year. So I think if you hit like the $100,000 tax bracket, then hypothetically, if you're going to pick out one way of you want to make money in a taxable account, you want to prefer to make capital gains versus dividends or interest, because interest will be taxed fully. So it's kind of known as, like, I think they know it as employment income. And your employment income is basically, well, there's technically 4, which is like your employment income. So you go to a job, you work at a job site, that's taxed a lot more higher than capital gains. So in Canada, what I was taught in my tax course is that capital gains, they're taxed as this. So it's taxed as, for example, you make $1,000 capital gain, only 50% of that, so 0.50 or 50% of that is taxable. So in that case, $500 in this case will be taxable. And let's just say that you're in a 40% marginal tax rate, which is a little bit challenging to see. I could probably search that up real quick. We can see it on Wealth Simple, I think. Ah, okay, I see it. So I found this kind of interesting. So what we have right here, I'll make this a little bit smaller. So we have like 15% on your first 49,000. So basically, if you make as you make that amount, basically it'll be taxed at 15%. And if you make a bit above 49,000, let's just say you make 98,000, about 98,000, so it'll be 98,040 minus your 49,000. In that case, 49,000 of that will be taxed at 20.5%, and it climbs. So we're in a bit of a, I think it's called a progressive tax bracket. We don't have a flat tax. I'm pretty sure Russia has a flat tax, but in Canada we have a progressive tax bracket. So if you make only 49,000 in this hypothetical example, you're gonna only have to pay 15% of that. But if you make a lot of money, so in this case, if we're assuming in this case that you're in a 29% tax bracket, I'm just gonna assume that we're in a 29% tax bracket. So in this case, we're gonna assume it's a 29% tax bracket. So in this case, we just do. Basically, I'm sorry, this has nothing to do with bonds. This is just taxes, which I'm just trying to explain something a little bit. So in this case, it's $500 times 0.29. You would owe about $145 in capital gains taxes. While as with dividends, for example, I'm pretty sure you'd include a gross up of 1.38 or 1.15. It depends on like the company. Some companies that are eligible, it's 1.38. It's a little bit complicated to calculate like your dividends, how much tax you owe, but I know it's definitely not as efficient as capital gains, because when it comes to capital gains, only 50% of it is taxable. And then while it's with interest, the full amount is taxable. So let's just say in this hypothetical example, we make $1,000 in interest. Well, about 100% of that will be taxable. Whereas with capital gains, it's only 50%. So in this case, we'll do simply, basically, if we're assuming the 29% tax bracket, I'm not 100% sure if this is correct, but it'll be 1,000 times 0.29. So in this case, we'll have to pay $290 off that 1,000. Dividends are somewhere in the middle. Capital gains are most efficient. Interest is the least efficient. And then employment is pretty bad too. So I would consider interest in employment is not as good. And you might be asking, like, why is that the case? Well, preferably they want people to invest in stocks and to grow companies and have ownership in companies. Whereas with dividends and interest, it's a bit more of a passive management strategy. Hold on 1 second. I'm gonna get a blanket and I'm gonna get started. It's a bit cold. I'm gonna turn on my fan too. It's like, I don't know, I'm all over the place lately. But so with that in explanation, I think we can actually do a difficulty 2 just to play around with things. And I could probably do a hypothetical where I have a good gain on a bond and I don't want to keep it for interest. I could sell that for a capital gain, and then that would be taxed as a capital gain. I could maybe do a hypothetical and say, this is how much tax you'd have to pay if you kept this bond. Well, as with me taking a capital gain, I might be able to. So I'm going to try out difficulty 2. Plus, I've already did an entire series of me playing on difficulty 1. It was a piece of cake. So, we have got started. So, we're going to do $100,000 USD. So, in this case, congratulations on opening your new brokerage account. You've completed the necessary paperwork at $100,000 USD. In this case, we're in hold. So, this is with Canada. Every brokerage has this, a holding period, where they have to check for a criminal record, whether or not you're an insider, whether or not you're a politically exposed person, just to make sure that you aren't doing any insider trading. I don't qualify for margin or short sales or options trade or futures trade. Doesn't matter because I'm going to be doing bond only in this strategy besides doing convertibles. So in this case, I'm going to do I want to do streaming. So I usually do the streaming quotes list and the commodity prices. The commodity prices is definitely the most helpful for this challenge because I have to know what the current interest rates are. I'm just going to bring this into a little bit more accessible. So we'll just fast forward until it hits January, I think 15th. 16th, my bad. So we got our brokerage. So now we can actually buy and sell securities. So I always forget to include that timer. So right now we're at a ticker speed of 99. I usually like to do it like the fastest speed. That's because I can comprehend things pretty fast. But as a beginner, or for you guys' sake, I would say I'm going to probably change that to 77. That way you can comprehend what's going on and everything. So right now, I say interest rates are quite high. They're at 7.5%. So we're going to go and see what the policy is when it comes to these interest rates. So currently right now they're easing, which is a very, very good environment for me because I'm going to be able to lock in my money at 7%. And the Federal Reserve monetary policy, they're easing. So that means that they're going to be lowering the interest rates. So the short bond is taking a tank lately. And that's because basically the central bank is saying we want to ease money. So right now, we are currently under a real life example. I could do Canada as a start. So we got this thing called the Bank of Canada. So they're basically our central bank for Canada, because I'm Canadian. And currently, CPI is at 2.2%, and the policy rate is at 0.25. So we had to cut during coronavirus, we had to lower interest rates because we wanted to basically stimulate the economy, make borrowing cheaper. Therefore, we could get spending back in track. So right now, we've been at 0.25 for a long time, but we were pretty high interest. We're at a little bit higher interest rates before Corona. But thanks to coronavirus, we're at much lower interest rates to help battle this coronavirus, which I found kind of interesting. And I think currently right now, I think we're in a bit of an ease-in policy. So if we look over here, we can see like the about the bank. We can see the research. The press, I think, is the most important because this is where it comes into case. They're basically saying to the press, aka me, that they're easing the interest rate. They may change their mind. They may not change their mind. But in this case, I'm pretty sure when it comes to real life, I feel like Canada, we're in an easing environment. But I'm thinking that in the future, maybe in the next 2-3 years, interest rates are most likely to go up because that's when we're going to be fully employed. And if you also want to predict interest rates in this game or in real life, you look at, first I would say, look at what the central bank thinks, and then you can kind of control that. But also what I found interesting is you can go through economic statistics. So currently, USD GDP growth is at 4.6%, so the economy is growing pretty fast. Wait, oh, okay, economic statistics. Prime rate on loans is pretty high. But we can also see like tax rates. So this is where we're going to be referring to this a lot in this series because I put it on a difficulty 2. So tax rate on corporations is 21%. Not going to be very relevant for us. Individual tax rate on ordinary income is 26%, and capital gains is taxed at 18%. So in this case, what we want to do is we want to buy bonds. What the thing is that bad about bonds in this case is, if I get that notepad out again, let's just say hypothetically we make interest income, in which we're going to be making a lot of interest income basically. We make $1,000 in interest income. Well, about 0.26% of that will be taxed. So in that case, if we do our math, so it's going to be about $260 will be taxed in this case. In this case, if we have about $100,000 invested, which we're going to invest most of that $100,000, let's just say we're going to make about a 5% return. That would give us about a $5,000 annual income, right? Oh, my bad. I did the math wrong. $5,000 in annual income, which will be taxed at 0.26. So I want to try to aim for a 5% return for ordinary income, but whenever our bonds do become worth more, I want to take the capital gain ASAP because it's more taxable. It's more tax efficient. So if we make $100,000 in, if we make $5,000 in income, about $1,300 of that will be taxed a year. So we're gonna make about 5,000 subtracted by 1,300. Oh, my bad. We're gonna make about $3,700 a year. So thanks to taxes, our return. Our stock market return, no, not our stock market returns, our returns on our investments will be a lot lower thanks to tax. So we're going to really have to consider what our tax course taught us is after tax. So we're going to do most of our decisions based on after tax. So what we're going to do is we have to do a bit of analysis, whether or not it's better to sell bonds or keep them. Some cases it makes more sense to sell your bonds, sometimes it makes more sense to keep them. But in this case, with the difficulty being higher, I think it makes more sense to sell the bonds because we'll make a capital gain. Well, that's enough bickering around with the theory. I think it's about time we get started. So, economic statistics. Okay, so crude oil, I don't really see anything really saying that, like, whether or not... I don't think housing starts is very, very important because it doesn't really tell you much. But housing starts is a leading indicator. If more and more people are building houses, typically the better the economy is doing. So I think over the next few months, we should see housing starts grow. So I found that pretty interesting. So in this case, I'm going to go ahead and implement a bond laddering strategy. So if I could Google this real quick. So this is going to be my main strategy. This is going to be like my main strategy that I want to implement when it comes to our series. So it basically, what it does is it spreads your interest rate risk. Sorry if my keyboard's loud. I have it right beside my mic. I shouldn't have done that. But, for example, if you go up there and you buy a 30-year bond, for example, you're going to be very, very interest rate sensitive. I can't spell sensitive, but okay, you're going to be very, very interest rate sensitive if you buy a 30-year bond. So if interest rates go up by 1%, hypothetically, so they go up by 1%, basically your bond is going to be worth a little bit less than it was. So it's going to be very, very sensitive to interest rates. Typically, the longer you buy a bond, the more interest you receive, but also the more sensitive it is to interest rate increases or decreases. So a great way of I like to think about it is if you buy a 30-year bond at 4%, that's great. You're going to make 4%. But what if interest rates go up 1%? Well, basically there's a 5% bond out there that pay for 30 years. Which one would you rather buy? Would you buy one that pays 4% or 5%? Well, in that case, I would buy the 5% because I make an extra percent more. So in this case, your 30-year 4% bond will go down in price to basically to match basically this bond up here. So it's kind of interesting. Whereas with a 1-year bond, if interest rates go up, it's not going to matter because your bond's going to mature in 1 year. Whereas with a 30-year bond, 30 years, you're locking in your money at 4%. So hypothetically, it doesn't make any sense to really keep that bond because it's going to make like, I don't know. It's just personally, that's what I like to think about it because you're locking your money in for 30 years at 4%. So there's a lot of risk with that. So unless interest rates are really, really high, I'm not going to lock my money in for 30 plus years. I'm going to do short bonds mostly. I want to do medium term bonds. And I want to do long. So like this is where we go into like the long bonds and stuff. So like if I do bonds Investopedia, because I'm not an expert at this, I'm still kind of novice at bonds, but I understand the theory behind them. So there's basically an IOU, you're lending money out to a government or a corporation. That's basically what they're saying right here. You're receiving interest. Issuers of bonds, so corporations or governments. So governments typically use it to buy infrastructure and stuff. Here's the bonds. So they trade over the counter. So I'm going to have to buy them from someone else, like a corporation. And basically, the advantages: receive income through the interest payments, hold the bond into maturity to get it all back. So basically, hypothetically, if my bond does go down in price, I could wait 30 years and I would receive 100% back. So it's not the end of the world, but at the same time, you're locking your money in for 30 years at 4%. So it makes sense to sell your bond every so once in a while, especially if you make profit, because that's just my opinion. You could just do the strategy where you just buy a 30-year bond, receive 4%, and just keep that income for life. Well, but what I do is I usually just buy long-term bonds whenever I think interest rates are high, and then whenever interest rates are low, I sell the long-term bonds, receive a giant capital gain, and then I keep that money in cash, and then I basically wait until interest rates go back up. So yeah, it's kind of interesting. But the disadvantages: pays out lower returns than stocks, and they can default on the bonds. So that's what basically, it's pretty low chance that the government is going to declare bankruptcy in this game, but they can probably, and in real life too. So corporate bonds are going to be a lot more high risk. Bond yields can fall. That's another disadvantage. So that's why I basically explained with the 4% bond to the 5% bond. The face value, that's basically the money that you're lending out. So all bonds, they trade at $100 in this game. Well, they trade above $100, but this is known as a par bond, and above $100. So if the bond goes a bit above 100, it's known as a premium. And if it's below 100, it's known as a below par bond. So what I'm probably going to be doing is I'm going to be looking for below par bonds in this game because they're trading less than 100. So in this case, because in this hypothetical example, if interest rates did go up, maybe we bought this bond at $100. Well, in this hypothetical example, if interest rates went up 1%, our bond might be worth $94. I'm not too sure on the exact calculation for it, but as long as you understand the theory, I think you should be alright. The coupon rate, etc., issue price, defaults are pretty intimidating. Varieties, you can do zero coupon, you can do convertible. Convertible bonds is one thing I'm going to do because I find that kind of interesting. You guys can pause the video and read about this. PS, if you guys are having a little bit of trouble with everything, yeah, Investopedia is basically the best source, I think, for beginners because they explain everything. And if you don't have a lot of trouble with it, you can always just Google it. But pricing of bonds, so this is like they trade at 100, and inverse to interest rates. So this is a big risk about buying bonds. So in this case, is basically where I explained the 30%, the 30-year bond, yield to maturities, real bonds. So I'm gonna keep this website open just in case if I want to read through it while I'm buying. But right now, I think it's about time we stop going through theory and we actually apply some things. So I'm gonna write this down on a piece of paper because I might want to work on some timestamps. Okay, so that's enough bickering about the basics of it. Now I get to show people who I think learn best by doing. So in this case, interest rates are going down. So in this game, with interest rates going down, I'm very, very certain that buying a mix of corporate and buying a mix of buying basically a long bond would be a good idea. So we're gonna lock in our money. We're gonna lock in a full 100,000 at 7%. Oh, this might be pretty interesting. So we got AA for the government long bonds, which is pretty good. AAA is the best. So that's known as the credit rating. So as you get lower, I like to think of it as school. So if you get an A, you're considered a pretty good student. Whereas if you go down to like the D, you're considered not really a bad student. That's a bit of a bad way of saying it. But I like to think of it as, hey, if you get an A, you're considered really, really good. And then if you're considered D, you're not considered as good. So in this case, I'm not going to be buying any non-investment grade bonds, which are known as, so I can Google this real quick. It just as a bit of a, so I'm going to do Investopedia, I guess. So we got this thing called investment grade definition. So this is probably the last hypothetical. So A to B, AAA, and then we got something called junk bonds, which go below BBB, BB, B, and C. And I think you can also buy D bonds in this game. I'm not too sure. But typically, triple A to double B, triple B is considered investment grade. So that's considered pretty great quality. Whereas if you go down to like the BBs and the Cs, you're basically buying highly speculative pieces of debt, where they're basically could go bankrupt or you could make a lot of money. So right here we got your investment grade details. So these are typically known as high capacity to prepay their loans. So typically AA to AA. So in this case, with the hypotheticals, so in this hypothetical example, it's very, very likely that they're going to repay us back our money if we do want to hold it. So we're going to make about 7.75%. So I'm pretty happy with that. It's non-callable, which is great. So basically the bank, the issuer cannot say, hey, I want my money back. Oh no, they cannot call it. So every time people call back bonds, they're paying back 100. So in this case, we look over here. We paid $108 for that bond, and it's paying us 7%. So we paid a bit of a premium for this bond. If they were to call it back, they would have to call it back at 100. So in this case, we'd lose $8. So in that case, we lose quite a fair amount of our money if it got called. So that's one big thing to keep into consideration, is whether or not the bond is callable or not callable. In this case, it's non-callable, so I don't really care. But if it was callable, I would make sure it is below 100 or at 100. If it's above 100, then there's a lot of risk when it comes to that. Because if they decide to call it, you could potentially lose your income, and you overpaid for the bond. So in this case, and you don't always want to buy bonds that are trading below 100, because a lot of the times the income is actually worth it. So in this case, in about 2 years, we're going to make in this case, if we hold this bond for 2 years, we're going to make almost all of our money back that we paid for. That's not including tax though. So in this case, we're just going to hold this bond, and now we're going to hit the play button. So we locked in our money for this bond, and now we're going to be looking at right here, the interest rates. So look at the short rate, it's continuing to fall, so that's some good news. And right now, bonds are trading at 6.49%. So in this case, our bond is worth more, because in this case, we bought it at, so our bond, the market price of the bond now is $113, and we bought it at $108. That's because they have an inverse relationship. Interest rates went down by a bit, so I would bought the bond at 7%. It's currently 6.49, so my bond is better. So in this case, we have a $5,000 gain, and that's a capital gain. but we're going to receive some coupons every so often. So if I look over here to my annual cash flow, basically we're going to make $7,100 a year in government bond interest. And basically, the bond premium, I don't know what that means. I'm pretty sure that means that like the $8 we paid above. But in this case, we got our tax on projected income. So in this case, if we made basically, so in this case, we're making $7,130. And I'm pretty sure that interest was 29%. So it's negative $300 because I think we paid a little bit extra for the bond. So I think that's a little bit of a tax deduction. But in this case, we're almost close to that. So this is approximately how much tax we're paying. So in this case, I want to try to sell this bond for a premium ASAP. So that's enough in the hypothetical. This game is a very, very slow pace. So interest rates keep going down. Oh, they spiked a little bit. So where is the short rate? It spiked a little bit, yeah. That has me a little bit worried. So now I'm going to go see what the government policy is. They're still easing, but they may change their mind like a snap of my finger. And I could lose lots of money because I locked my money in into 2042. So I locked my money in for almost 20 years. So like I said, this is a very, very interest rate sensitive security. But we are making bank because interest rates keep going down. And everyone loves my 7% bond because everyone else is making 5. So if interest rates keep falling, we're going to make more money. So I'm going to go ahead and speed it up real quick, 99, for a little bit. Interest rates keep falling. I don't care about this company because we're not doing any stock. Interest rates are at 4.79. They keep falling. So look, interest rates have been tanking. So if you look at the short bond, it's been falling consistently. So if I see the short bond go up a little bit and start to make a bit of a reversal on the technicals, I'm probably gonna go ahead and exit my bond. Right now, I'm gonna keep it for the coupons. So right now, bonds are pretty bad because we're in considered a low interest rate environment in this game. So that's where I like to go into the bond laddering strategy. Oh, that's a snipping tool. I want to paint. Okay, so I think right now is a good time to maybe take my profit on that bond. Maybe. Yeah, so I'm going to take my profit on this bond. So right now, it's currently paying me about 7.75%. My annual cash flow stays the same, so I'm locking my money in. That's why they call it fixed income. It's because when you buy that, you make a fixed income. So in this case, it would probably make more sense, hypothetically in this example, to actually take our profit out of this bond. So we're going to take almost $61,000. So if we do the hypothetical example in this case, if we go over to the economic statistics, 18% of this will be taxed as capital gains. So I'm pretty sure they don't include the 50%. Who knows, they might. I'm not sure if 50% of the taxable of the capital gain is taxed. But let's just do 2 hypothetical scenarios on how much tax we're going to have to pay. So in this case, we have a $61,000 at 173% gain. If we times that by 0.5, we get a $30,000 gain, and we times that by the 18%. So we should pay, at the lowest level, we should pay $5,000 in tax, which I don't think is likely because this game, I'm not sure if they include 50%. Who knows? If it is this way, I love capital gains. It's going to be my new way of making money in this game because in this hypothetical example, and this would be real life in Canada, we made a $6,000 gain. We made a $60,000 gain. Only $30,000 of that was taxable. And if our marginal tax rate is 18%, we're only going to have to pay $5,000 of taxes with basically a $60,000 gain. So if we do basically, I'm just going to round that. So if it's 6 1s 173, it's $5,000 but I think it was 5,500 in taxes. But right now, you kind of get the picture. We'll basically have a $53,000 gain. But in this case, I'm assuming that is not the case. I'm assuming that it'll be 61173 and times 0.18. So in this case, this is the highest tax we might have to pay, 11,000. Not a big deal. While I was with this, with income, it will be a little bit less efficient. So it might make more sense to actually take our profit. So I'm gonna go ahead and sell the bond. Currently, the current yield is 4.44%. So that's pretty bad. But I'm still gonna get out of it because it makes more sense to honestly get out of it. So in this case, we have $162,000 in our income. So we just timed the interest rates perfectly. In real life, of course, it's going to be much harder to time interest rates perfectly in real life, but in this game, it makes it a bit more interesting. So in this case, we made about a 62% return before tax. But if I look at my account summary, how much tax will I have to pay? Where is it? Realized capital gains, 60,000. Year to date, tax on ordinary income. So this is the interest we made, about $2,000. So that's our ordinary income taxable. Year to date accrued tax. So this is how much we're gonna have to pay. So I'm pretty sure that the worst case tax scenario is a thing. Yeah. So I'm pretty sure in that case we made 61,000 whatever, and then times 0.18. So in that case we made almost that much. Plus so in that case I think it makes more sense for me to make more capital gains just because it's a little bit more efficient than bond interest. But you might be asking, why did you sell your bond when interest rates are at all-time low levels? And it probably doesn't make any sense to really buy bonds at all-time low levels. Well, I think this is where we go into like a decent bond strategy, in my opinion. Well, this is not really financial advice in any way, but I think, in my personal opinion, whenever interest rates are low, it probably makes more sense to do a bond laddering strategy. So if I look at it on Investopedia, for example, this is like a strategy. This is one of my favorite strategies for bond management. It's called bond laddering. So bond laddering is an investment strategy that involves bonds with different maturity dates, so the investor can relatively quickly change this to interest rates. So basically, you're buying a 30-year bond, a 5-year bond, a 1-year bond, a 2-year bond, and you're just spreading across your interest rate risk. So in that case, for example, if interest rates go up, hypothetically your short rate bonds will be good because those are going to mature soon and you're going to be able to lock in the higher rate. Whereas if interest rates go down, your longer bonds are going to do better. So in that case, you're kind of diversifying out your interest rate risk. Instead of what I did right there in this game that I'm playing, I did something stupid. I basically went all in on long-term bonds. Whereas if I did a bond laddering strategy, I would have bought some short bonds, whatever. So what I know in this game is it's very, very likely that interest rates are going to go up in the future. So it will make more sense for me, hypothetically, in this game to buy up a bond laddering strategy where I have some short bonds, like for example, a bond that matures in 1 year. Then therefore I'm going to receive my principal in 1 year. And then I'm able to buy another bond at a higher rate. Basically, it spreads across my risk a lot. So generally, short-term bonds mature in less than 5 years. So I'm looking for bonds that mature in less than 5 years. Height of the ladder. So I can do different rungs of the ladder. I definitely think this is a good read, especially if you want to do bonds. But basically, this is a great idea for me personally if I want a capital preservation. So I'm going to be going for some capital preservation in this game by doing a bond laddering strategy. Just spread across my risk. I'm not going to do any long bonds. I might just do short bonds for the time being. And if interest rates do go up, I'm happy. Let's go with my OBS. Get rid of that. Okay. So now, I think this is always very, very helpful to pop up. Is currently 2022. Interesting. So I find that very, very helpful, because if we know like the day, then we can really help make our ball and iron idea. Bring this up a little bit more. So I'm gonna have this as this. So this is like the current year. We're gonna build up our ball and iron strategy right now. So we do a recall database to search for our bonds. I find this a little bit harder in real life, but we could do convertible bonds, which are basically a mix of stock, and we're gonna do a 0% because I don't want to pay over the top for them. So in this case, Samsung Corp might be a good convertible bond to buy. Matures in 2035, and as we know, the current year is 2022. So in this case, it might not be worth it to buy that bond, especially because it's paying such a low coupon. So in my opinion, it might not be worth it. But then again, interest rates are also low. 2026, triple B. I'm looking for basically below par bonds. So National Bank of Canada, or is this Greenland? Don't know. That might be a good one to buy too, because it pays 2.4. So I'm going to do a bit of analysis on the stock. I might just do this one. So this is how I'm going to cheat the system in this game, and I'm going to own individual stocks, but I'm not going out there and buying the individual stock by itself. I'm doing the convertible bond. It's currently at $48 a share, 14 times price to book, 6.9%. Okay, double A. So I think this would be a very, very interesting bond to buy. So I'm going to go ahead and take a bit of a stake in this, just because I think it's interesting. So the convertible price is $67.52 a share. So I found that kind of interesting. So if I cancel this real quick, and if I look at the chart of the stock, it's taking a bit of a dip. But I think if it goes above 64, then it'll make sense to convert our bond. So if I'm betting that the stock is going to go up, it might make more sense to actually do the convertible bond, which I'm probably just going to try it out. I might do 14,000. So in this case, it's trading below a bit below the par. So I want to buy $14,000 worth of this bond. So I'm going to divide that by 900 and where is it? 904. So I think we can buy about 15 of these bonds, and we should be able to reach our budget. So in this case, the total transaction cost, it will cost us, it doesn't pay as much, and it's a bit of a long bond. That's the reason about it. That's the bad thing about this. So this might actually not be a good deal for us, but I like it because it's convertible. So if this bank goes up a lot, we could potentially make a good capital gain. So it's probably not the best deal for us. That's why I'm doing such a small amount of my portfolio in this bond. So we did about $14,000, which I wanted. So in this case, we have this bond. It pays a garbage yield of 2.5%, but now we have basically stock in this company, but it's a convertible bond. So I think as long as the price of this bond, as long as the price of the individual stock goes above 64, we'll make a bit of a capital gain on it because it's convertible. So in this case, we have the right to convert X amount of shares. Here, let me see this. I always find this interesting to look at. So we have, basically we can convert into stock at $67.52 a share, in which we'll own about 14.8 shares for $1,000 a bond. So in this case, we'll own 14.89. 14.89 times 14,000. So we should own about that much dollars worth of the... No, that's wrong. That's how many shares we'd own. My bad. I think that's right. It'll be 14.89. My bad. Brain farting so hard. Sorry about that. Yeah, that's how many shares we should own, I think. I don't know, I'm kind of brain farting. But in this case, we're just going to buy, we already bought that. So now we're going to start implementing the, oh, we want to cancel that. So in this case, we're going to look for the bond iron strategy. So it's currently 2022. So we're gonna look for a very maturing bond very soon, just to add a little bit less risk to our idea. 2025, this is a B, so it's a little bit of a risk. I think as long as it's a short bond and it's considered junk, I think it's alright, but it might not be worth it. Who knows? Yeah, I think this bond is not worth it because it's going to yield us 1.39%, and it's currently $113, and it has 3 years left to maturity. So basically, in that case, if we were to buy about $1,000 worth of that bond, we would receive about $1. Let's just say we buy $1,000 of that bond, and we get 0.0139. We make about $13.90 a year, and that's for about 3 years. We'll make about $41 in return from that. Well, but it's trading at 113, so that'd be 1,130 minus our $41 in coupons. We'll lose about $89 if we bought a $1,000 bond. So hypothetically, it makes no sense to buy Quaker Oats bond right now because I see the coupon is lower than the potential current price. And if it was a longer term bond, I'd be okay with it, but it makes no sense. And plus, the yield is just so small. So, with this into consideration, I'm thinking we mainly keep cash as of right now because bonds on these bonds aren't super duper good. And I'm not seeing any that, 2023, this one could potentially be good. No, not worth it. Maybe the 2027? No. All these bonds are bad at the moment, so I can't find any super duper good deals for the bond ladder strategy. Oh, because I'm looking at convertible bonds. That's my bad. I should turn off the convertible bonds because basically, hypothetically, within convertible bonds, if the stock goes up a lot, the bond is trading for a lot more. So these stocks are probably doing really, really well. So hypothetically, I just want to do just regular bonds. This should be a lot better for our bond ladder strategy. That was my bad. So 2025, this is about 3 years out. It pays about 4%. So a little bit above the premium, but in about 3 years, we make about 4, 8, 12. So we're gonna make about $112 in gains, minus our 3. So we should make about 109. Minus our tax, we should be able to make a decent profit on that. Should. 2036, that's a bit of a longer term. We're looking for a very liquid bond. We're like some below 5-year bonds. Who knows? Interest rates might stay low for a while. They might go back up. So that's why I want to do some very liquid bonds of like 1 to 2 years. Hypothetically. I can't find any 2023s. Yeah. So I think that's almost about good. 2030. I'm probably going to buy a 2030 bond. This seems pretty good. So I think the company is pretty sound. Going to buy so in this case we're going to buy up a 2030 bond that pays us 5.8% coupons, and so like we're going to buy a 2030 bond. So this is a Raymond. So in this case we're going to buy maybe I should look at our budget too. Our budget might be pretty good, so I think it might be a good idea to maybe buy 43 of these. So we're going to be pretty interest rate sensitive because we bought a bit of a longer term bond. So in this case, we have about, if we look at our account summary, we have about $50,000 in long bonds. And so I want to keep the rest in short bonds and cash equivalents because I'm pretty certain that interest rates are going to go up. But these bonds I bought are basically higher risk because I bought them for a longer term. So that was a bit of a dumb idea, but I'm pretty certain that they're going to be good for just mainly cash flow reasons. So when does this one mature? 2034. So this is Natel. So this is convertible. It's always good to like know that this is like an individual bond. This is a convertible. So in this case, we're going to look for some shorter term bonds just to help reduce the risk. because I'm pretty certain that interest rates are going to go up. If they do go down, our long bonds are going to do very well. But right now, I'm looking for very, very liquid bonds. So 2025, this might be pretty good. 2024, this one's pretty good, because it matures in about 2 years. So if interest rates don't go up for 2 years and then they start going up 2 years from now, this could potentially be a good deal for us. And we're going to make about 8% off of it. So we might make a bit of a profit on that. But we're paying a bit of a premium for it, which sucks. 2025, this one's probably our best bet. Yeah. So we're going to do a 2025. And this one will be AXA group. And it's below par. So in this case, I think this one will be a good one to buy because it's a bit below par. So we're gonna basically not lose money on this bond unless they declare bankruptcy, which is pretty unlikely because they're AA. So I'm gonna go ahead and I'm gonna consider maybe put in. That's a bit hard. It's always hard coming out with your budget. I'm probably gonna buy 50 of these. So that's about a $50,000 bet. And so in this case, if we actually look at like our bond portfolio, we have some Natel. So if I like to do this every so often. So if I go over here, I do. I think this might help put a bit of a brighter picture into people's heads of what like the portfolio allocation looks like, because I think that's one thing that they don't have in this game is they don't show you like a visual representation of charts and stuff. So I'm gonna keep I'm gonna keep this much in liquidity, unless I find like a 1-year bond or a 2-year bond. It might make more sense to buy that too. It's currently 2022. Don't see any 2023s. This one might be good too. 2026. 2038. 2023. Yeah, these are all. Oh, I think I found something. Oh, that's 23, my bad. I swear I just saw a 2002 bond or something. But 2024, this one might be good. 2029. Oh yeah, this one would be very good, I think. 8%, and so we're pretty likely to make some money off that bond. This one looks a little bit better though, because it's paying a 9% coupon. It's trading for the exact same price. So I think this one's the winner. And I think that's going to be my last bond I'm going to buy for today. I think I spelled the name wrong. So I want to put about, yeah, so I want to put about maybe half our bet into that. And we're going to keep, no, I think that's a bit of a dumb idea. So I'm going to probably do maybe just 15 of these. I want to keep some liquidity just in case if interest rates do rise, and they're pretty likely to rise. So I shouldn't have put so much of my money into like longer term bonds, but worst case scenario, we have these 2024 and 2025 bonds to basically offset our losses on our bond portfolio, because we're highly interest rate sensitive now because most of our money is in bonds instead of individual stock. So I'm going to do this on my second monitor. I'm going to build up a bit of a visual representation. So this will be the issuer. We got the issuer, and I'm just going to do the value. I think it might just be good to come off a bit of a visual representation through Excel. So this is Natel. I'm just doing this on my second monitor. Sorry about that. We got Raymond. And we AXA group. And we got DAWO group. I think once we build this Excel spreadsheet, we're pretty much good. So the value of the bond for Natel is 14,687. And the Raymond James is worth 44,511. 49,803. And then Dawu is 15,555. do some dollar signs. Here's what our thing looks like. So if we do insert, I think insert, and we just like little pie chart, we can do it like a little 2D pie. And then I'm pretty sure what we can do is we can select data. We can add. So our series name would be like this, right? I'm pretty sure if we do, I think we want to edit this then. And the values would just be this. Select that. We have a bit more of a visual representation of where our value in our portfolio is, basically. I think if we could do also data labels. I want to do data labels. Can we do legend? I want to do more options. I want to probably change around this a little bit. It doesn't show names though. That's the one problem. I'm pretty bad at I'm not super duper good at Excel, but I'm pretty good at it. But here's a bit of a visual representation of where our portfolio is. Oh, I think I might have messed up the data then. Select data, remove, add. Our series name will be known as the data range will be here. Whatever. I'm probably not going to mess around with this Excel thing. I just wanted a bit of a visual representation, but I could always just do the math and calculate myself, like the percent of the portfolio holdings. So now we know with this that we're going to be slightly liquid, but we also have about $38,000 in cash just in case if interest rates do go up, and I find it a good deal. So right now we're just going to wait until 2024, 2025, and maybe 2030 before we do any big deals. We shouldn't have done so much deals because that's our one problem, because we're highly interest rate sensitive right now. But I'm mainly just doing it for cash flow, so we're making about $6,000 a year. We owe about $11,000 in taxes. I forgot to include that into my calculation. So at the end of the year, we should have about $32,000. So in this case, I'm pretty glad I kept some cash then for taxes. So Natel, we're waiting for it to go above $60 before we go ahead and buy more. Might be a good idea to buy more of the convertible bond on that stock right now, maybe. Because right now it's taking a bit of a beating. If we look at it, we've lost about $400. The current price right now is at $92, so it's a little bit cheaper now for the convertible bond, and the income should be a little bit higher, hypothetically. I'm probably waiting for the stock to be beat up a little bit more. It may not. What's the bond now trading at? It's trading at $90. It could probably be beaten up a lot more if interest rates do go up, so I hypothetically don't want to buy it. Right now it would make more sense to buy the stock right now, but I can't do that because I'm doing bonds only. So right now we can see that interest rates are kind of flatlining. They're not going down anymore, so they're pretty likely to go back up. So I'm pretty not hyped that I locked in a lot of my money into longer term bonds right now. We're still gonna just keep that. We're just gonna start building up our cash right now. So we're seeing about $6,000 a year in cash. About $4,000 of that will be after-tax income. So that's not all that bad. But we're very, very interest rate sensitive because we have a lot of our investments in longer-term debts. AKA, we have a 2034, a 2030, a 2025, and a 2024. So we have to wait at least 2 to 3 years until we get most of our money back. So I'm going to start looking for some more liquid bonds, if there are any. 2027, 2024, that's probably a good one. But right now I'm not finding any good deals. Yeah, I'm having trouble finding some very, very short bonds. Maybe there's some in the junk category. No, these are all long. So like, well, they're not, I would consider them as short term, but I'm looking for like bonds near maturity, just for extra liquidity and maybe for a little bit extra cash. But nope, can't find anything good at the moment. Kind of wish we bought some ETE stock because their stock just keeps going up. but we can't do that. I'm going to be doing bonds only, so we're highly interest rate sensitive. So in this case, we've definitely lost money off our bond portfolio. So we lost $3,000 off the convertible, 1.8 grand off that, and etc. So it probably makes more sense. I should have kept more liquidity, but we can average down this bond potentially. But I'm going to keep cash as of right now because I'm pretty sure interest rates are going to be going up more. I'm pretty certain that the 2020, right here, 2025, about $48,000 is coming due 3 years from now, and about 15K of that is coming due by 2024. So we'll be getting about 60-something thousand, basically by 2025. So we're pretty much golden when it comes to that. And we're still receiving interest right now. So that's the benefit of buying the short bonds, because it's not going to matter. Because right now we're losing a lot of money off our bond portfolio because we bought bonds and we knew that rates were likely to go back up, but we bought them for a bit of a shorter term duration. So we have a lot less risk with those, and we still have some cash left. And we always use that cash towards averaging down our bond position, reducing our cost basis. And we could potentially make more. So I should have kept more cash, hypothetically, because if I kept more cash, then we wouldn't be losing as much. Because right now we're actually losing a lot, especially off our longer term. For example, our 2030 and our 2034 bonds are getting hit really, really hard, whereas our short-term bonds are hit hard, but not as hard. Like our Raymond James bond is the worst performing at the moment, but it might be a good deal to buy it. It might be a good deal because it's yielding about 7%. GDP growth is negative right now, which is shocking because interest rates should hypothetically be going down, but right now they're tightening. So that's just because that's just what their policy is. They want to raise rates. Right now is typically when I like to go into bonds, around the 8% range, but right now is when bonds start getting a little bit more competitive. I bought them at a very, very bad level. I'm gonna have to pay the price for what I did. This is 91. It might be a good idea to buy more of the AXA group because it's yielding about 4%, 7%. This one would probably make more sense to buy because it yields. It's into 2024, and it's trading almost at par. It's just a little bit above. So we'll make about a year's worth of income off of it, and it matures in about a year. So I'm pretty much happy with that. Because if we look at the current year, it's currently 2023, and this bond matures in 2024, and it would yield us about 8%. It's going to mature very soon, so I'm going to go ahead. I'm going to go ahead and buy up all the bond. So I'm going to buy 30 bonds of this. So we're hypothetically going to have to pay maybe a bit of tax, and we're not going to have as much money to pay for that tax. But I'm hoping that in the next year, I'm hoping that we make a bit of a profit out that bond. Yeah. So right now we're heavily weighted on this bond right here, but it pays us about 8% a year. So we should make some good money off of it. Yeah, so I'm definitely not going to make that mistake again. If I think interest rates are likely to go up, I'm not going to buy bonds. If I'm thinking they're likely to go down, I'm going to buy bonds. So it make more sense for me to keep a little bit more heavy weighted in cash, because cash it doesn't move in price. If they had savings accounts in this game, I'd be doing savings accounts in the low interest rate environment and then just waiting for them to go back up. Negative, so they lost money that year. They lost money that quarter, I mean. So I could potentially hurt the bond. So right now we're making about $8,000 a year. We have a maturing bond of $45,000. And we have about $5,000 in annual income. Yeah, so we're doing pretty well. and we're gonna have $45,000 to play with soon, and interest rates are a little bit higher than they were when we bought that bond. So that's the benefit of buying shorter term bonds, is right now we have the liquidity coming in. It's coming due soon. So now we can eventually use that liquidity that we got from buying the shorter term bond towards locking into longer term if we want to. And it might make more sense for us to lock into longer term bonds, or consider just doing the shorter bonds until rates do go up. Because rates might go up higher than this. So that's why hypothetically it might not be a good idea just for us to lock in right now, thinking that rates are going to go down, because who knows, they might go up, they might go down. Bond ladder helps reduce a lot of that stress where you don't really, where you're not 100% sure whether or not interest rates are going to go up or down. So with that into consideration, it will probably make more sense for us to do a bit of a bond ladder strategy throughout this entire series. So right now it makes more sense to go for a bit longer term bonds than shorter term. But then again, interest rates could go up even higher than this. So interest rates are starting to get really good right now. So we have about $4,000 in cash flow right now. How much do we have to pay in tax? $4,000 in tax. So we owe about $1,000 in tax. $1,800. Oh, and we're shopping at major department stores. Several of these department stores. What? This is like weird because you get like these weird little comments. So that should hurt some. What did that do? It might affect interest rates. Oh, they dipped a little bit. They're neutral now. They don't know where interest rates are gonna go. So right now, it makes more sense to bond ladder because we don't know whether or not interest rates are go up or down. So is there any liquid bonds we can buy? It's currently 2023, almost 2024. So we're gonna look for some 2025 bonds, maybe. Right here, this one's pretty good. General Electric. It's trading a bit below par at $95. It yields about 9%, and it matures in 2025. So we'd have liquidity. So I'm gonna put all my money into that bond, which is about $5,000. Shouldn't offer us that much income. And I'm gonna wait until our bond matures at 2024, which is the Dawu Group or whatever. I think that's how you pronounce it. They're maturing in 2024, so we should receive about $45,000. We'd be able to pay off our taxes, and then we'd have a little bit of extra money to maybe buy more General Electric bonds. And then I want to use the coupons from our other bonds, like our General Electric bond or Dawu, and these other bonds. I want to average down on these longer term bonds. That's one of my main objectives. Right now we're doing only corporate, but I should be throwing in some government bonds just in case if there's any corporate bankruptcies. So our portfolio is actually pretty stable, if you can see. Like, this is where we basically did that giant interest rate trade. And if we look at it right here, this is where we made our mistake and bought bonds at all-time low interest rates. And then we took a bit of a hit, but not as big of a hit as if we bought equities. So our bond portfolio is a lot safer than stocks in this case. That's because we're guaranteed $100 back, and we're guaranteed our interest. And whereas with dividends are not guaranteed. There's also many other reasons why bonds are more stable. So in this case, that's why we did bonds. So our General Electric bond should be worth more, and our Raymond James bonds should be worth more too, because interest rates are continuing to fall. So I'm kind of sad we didn't have any liquidity to buy more of the Raymond James bond, buy more of the longer term bonds, because interest rates are probably going to continue to fall. So this game is definitely a lot more boring when you do bonds. Even the convertible bond, it's like Natel Bank of Greece is not doing very well for us. It's not going above $67. If we wanted more entertainment, I could probably throw in some junk bonds, but right now I don't want to lose everything. I want to mainly retain my capital and just receive income. receive that 45,000? Yes, we did. So in this case, we received our money back. And we owe about $700 in tax payable. So in this case, we're going to look for some more liquid bonds. Current year is 2024, April. January, February, March, April. So we have about 9 months left. Where are some good ones? 2025, AXA Group. Currently pays 7%. And it yields, it's until 2025. So we did 9. So if you want to calculate the actual interest you receive, because 7%, that's misleading. I'm pretty sure what you do is 9 divided by 12. Oh, 9 divided by 12. You get that much. So times 0.0781 times 100. So we should receive about 5% return off this bond. That's including the things. So I think it might make more sense to buy more AXA Group, especially if we think that rates are going to go down. Then again, we're also going to keep pretty liquid because in about 9 months, this bond matures. And so it's pretty likely they're going to be able to pay us back. So I'm just going to throw all my money into AXA Group bond. And I think we're going to be averaging down, are we? AXA Group, we bought at 99. We're going to be averaging it down to 90, around 97. So I'm going to go and buy more of this because it matures very, very soon. I'm a big fan of bonds, especially when you get big in this game. Like if you have a lot of assets under management, it makes more sense to do bonds because I think it's a lot better because it's more stable income than dividends. Okay, so we're starting to make a bit of a comeback. Oh, that's the stock chart, my bad. This is ours. We're starting to make a bit of a comeback. Interest rates are not very high right now, which I don't like. Because I prefer when interest rates are nice and high, I can make good returns. But right now our bond portfolio is not doing very well. We're doing alright though, we're living. But it's definitely going to be a lot slower start. And it's going to take us a while to hit $1 million in bonds in this game. Because you don't get as much capital gains with bonds. But we definitely get security. Like this is like not much volatility at all, besides the whole fact that we made a bunch off those long bonds. Okay, interest rates are starting to go back up, so I'm happy. And it's currently August, so eventually I think that bond that we bought will mature soon, which is great. We received about $2,000 in coupons, aka interest. So in this case, we have about $106,000 in $104,000 in bonds maturing soon. So that's going to be awesome. Because once that matures, we can start buying longer term bonds or we can do more bond laddering. That's if interest rates stay high for about an extra year. Which I'm hoping. So this might be an easing environment because there's a bit of volcano that happened. So what are they thinking? They're neutral still. But there's been volcano activity in the Cayman Islands, I think it said. Oh, interest rates fell hard. Okay. So we want to pay attention to the short bond right now. Let's see where it's at. Did we receive our cash? No, we did not. We have to wait until 2025. That's the disadvantage about having the bond ladder strategy, is it will take about a year until we get our money back. And interest rates were higher about a year ago. And so that's one of our disadvantages that we have currently right now. So I'm just hoping that interest rates go up and we can not miss out on this opportunity. So I'm definitely going to have to keep some liquidity just for opportunities. This is why I like having the 50-50 strategy when it comes to stocks and bonds, because stocks you can actually make a bit more of a return, and then with the bonds you can also have basically guaranteed 50% of your portfolio in bonds. And then if you think interest rates are high and they're likely to go down, you can just do more bonds. And if you think stocks are cheap, then you can do them. So like they're a really good combo in this game, is stocks and bonds. Well, as in real life, you want to aim for more stocks because interest rates are low. So as you can see in this game, interest rates being low, you don't make much. So in this game, we're definitely getting hurt, even though interest rates have been moderate. Okay, we have our money back. So what I want to do, okay, what do they think with interest rates? It definitely is not helpful when they say in this game that they're neutral. So they're currently easing, so it makes more sense to go for longer term bonds. So I'm gonna go ahead and average down on our longer term bonds, like Raymond James or Natural. That's a convertible though. That's the problem. Let's just look for a longer term. So we'll look for a long term bond. That pays about 10% maybe. That'd be good. 9%, 2039. That's a pretty good one. What's the current year? I think that would be very helpful to know. Oh. Current year is 2025. So we can get rid of most of these, like definitely these ones right here. So it's 2025 right now, right? So now what we're gonna do is I'm gonna look for some long-term bonds and then just lock in for them and make some decent coupons. And then we can go ahead and we use that cash flow to reinvest at bonds if they decide to go into lower coupon territory. 2045. I'm looking for very long-term bonds, like very long term. I think Ford would be a good one because it's 2040, so that's like above 20 years out. This one's potentially good. It's AA too, which is great. I'm looking for, yeah, this will pay us about 9% return. So I think this won't be a good one to buy. The only problem is it's a very long-term bond. I think we might, oh no, we don't have margin unlocked yet. So right now most of our portfolio is in Swiss reinsurance and it pays about 9%. So we're gonna start going for a bit more higher coupon bonds just because I want to take a bit more risk. That was a high coupon bond, but that's just because interest rates were high and they just had to issue at high rates. And it's a safe bond too, which is good. So I'm going to start using that income. So right now we have about $11,000 in income. Minus our tax, we make about $7,000. So I'm just going to keep those coupons and just reinvest them. Or if I see a good deal, we'll go ahead and sell it. Currently right now I think it might make it sense to maybe sell them because as interest rates were high, this bond got beat up a lot because interest rates were high, and now that interest rates are going down, it's making our bond worth way more. So right now if interest rates continue to fall, it might make more sense for me to sell this, and then I'll keep more cash as when interest rates are low. Instead of doing that whole bond iron strategy, I'll do bond iron strategy maybe when I start seeing interest rates at 6 to 8%, because I think that's pretty good. But once they hit, if they go above 10 or whatever, I'm probably just gonna do longer term bonds. So now I'm without margin, so this is fun. So if I think interest rates are gonna go down, which they're pretty likely not to because it spiked up recently. If they're going to go down a little bit more, I may have used margin, bought like a long government bond, but I don't know where they're going right now because it kind of looks like it's not in a declining trend lately. Who knows? So now we can use margin. Basically, it's like playing with fire. So right now we have about a $27,000 gain. Yep, interest rates keep falling. That's good. Oh, company gone bankrupt? Okay. That's definitely why we want to avoid a lot of corporate bonds, because there could potentially be a bankruptcy, and then that would basically mean our bonds aren't worth anything because there's a default. I think last time I was playing, there was like this giant oil to like $500 scenario, and just companies were going bankrupt left, right, and center, and I had to rebalance my entire portfolio from cyclical stocks just to government debt, just to stay alive, because companies were going bankrupt left, right, and center. It was a very scary event in that game. So like I like the hypothetical examples in this game. So our stock chart. I hit my turn by accident, but we've been booming because we bought more long bonds. And interest rates keep falling, so I should have hypothetically used margin in that case, but it could have went back up and we could have lost everything. So I want to try to avoid margin unless I see a great opportunity that I don't have cash for. Margin is basically borrow money. Stocks in a tailspin. This is definitely a slower paced environment than I thought it was gonna. I thought it was gonna be a little bit faster paced, but that's what you get for doing bonds in this game. Is bonds, they're not very great for if you want fast pace. So I'm gonna get out of this company, and we're just gonna use the cash. We're just gonna load up on our cash, and then we're gonna lock in at a higher rate. So we have $151,000 in just cash. Of course, we gotta minus our tax, which our tax in this case is $6,000 in tax. So it made more sense because I actually saw that interest rates were going back up. So if they continue that trend and go back up and up and up, we could potentially lose our capital gain on that bond, and so I didn't want that to happen. I'm gonna clear out these companies. Just go back to fill. So we only own one stock, and it's for a convertible bond. So right now we're just going to keep a ton of cash until rates go up. And then once I see rates competitive and make maybe like 6 or 8%, once I start seeing the long bond hit about 8%, I think it's a really good idea to go into long bonds. At least go a little bit into them. I might go into like $10,000 or $25,000 increments. So I might buy $25,000 worth of the long bond at 8%. If it goes to 10, I might buy an extra $25,000. And if I see interest rates going down, I'll lock in higher. But the main reason is I want to keep a ton of liquidity just in case if interest rates do go higher, because then I'm able to have that cash towards locking in at higher rates, and then I'll make a higher return. So it's always nice having a bit of liquidity. Like currently right now with my real portfolio, I aim for more stocks right now, but I also have a ton of real stock. I have a ton of stocks in my portfolio, but I took some profits on my Industrial Alliance shares and everything else, which I found very, very interesting. So going back to like not financial advice stuff. My portfolio. Yep. So pausing the game, real life stuff. Here's like my portfolio. I do it through a Google Sheet, so I track all my stuff. I have a utility company, Enbridge. They're having a bit of trouble with like their line 5 at the moment. Suncor, Power, a bunch of stocks. These are all individual stocks, which I'm taking a bit of risk. And my portfolio too, which is my TFSA. I have plans on reducing my positions, so I'm planning on maybe getting rid of Industrial Alliance sometime in the future, especially when it hits like $78. I'm going to plan on trimming at it. But I also want to reduce my positions, and I want to start buying index funds and everything else. And if interest rates start going up IRL in real life, I plan on buying more and more maybe more bonds, but I bought a convertible bond at very, very low interest rates just because I wanted exposure to Cineplex stock, but I also wanted to receive income at the same time because Cineplex, they got rid of their dividend. So I found that kind of interesting. So going back to everything, we're going to go back to this game. So interest rates are starting to become a little bit more competitive in this game. And so it may make more sense for us to... I think this game is very, very helpful for teaching you theory, but it's not entirely realistic because we haven't really... Oh, I think interest rates are starting to go down. Or at least over the short term. Yeah, they're easing again. Yeah, there's a big, big ease right there. We might have missed out on it. Let me just go ahead and buy up a long term at 5%. We may get hurt for this. I'm gonna do a bit of a margin, and if they're gonna ease, I'm gonna be happy. So this is a bit of a high risk transaction because we already knew that they fell a lot, and now they're starting to flatten out. So it's pretty likely it might go back up or it might go down a little bit more. If interest rates continue to fall, we can make a bunch of money because we took out margin, which is debt. So right now I'm just looking at the short bond. I see it fallen and fallen. So I'm looking at the technical. And it's starting to flatten out a little bit. And as long as the long bond stays below 5, I think we're making money off this transaction. Yikes. Short bonds 1.7, 1.575. Oh, starting to fall down a little bit more. That's potentially good for us. So right now we have the long bond, and we got 52,000 because we borrowed money in this case. So this is a little bit higher risk stuff because we took out $200,000 loan, and we're considered triple B, but we took out debt to invest, which is very high risk, and we're very, very exposed to long interest rates right now. So it's not this greatest scenario right now if interest rates go up. I'm pretty certain that it might be a good idea to maybe take my profit. It's currently starting to flatten out for the long. It's flattening out for the prime. And it's a little bit volatile for the short rate. So I really don't know where interest rates are headed. Yes, they've been flattened. So I'm going to go ahead and not risk it and take my profit out of the long bond. So in this case, we have a profit on our long bond, right? We have about a $48,000 gain on our long bond. I'm gonna go ahead and take that. I'm just taking a little bit of extra risk with our bond portfolio, just to make things a little bit more entertaining. Because currently, right now, it's being very, very boring. Like this is personally why I don't like bonds as much, is because they're a little bit boring. But like, if you want like a bit of extra stability, it might make more sense to do more bonds. But in this case, it's been flat mostly. But we made a bit of money off that bond transaction, borrowing money. So I'm pretty sure we don't have any more margin, right? We do owe margin. I want to pay that back. So if I do MISC, I think repay margin loan. Cool. So now we don't have to pay back now we don't have to pay any more interest on that margin loan, and we have $195,000 in cash. And we have about $16,000 in taxes payable. So I don't even know if we made money off that transaction. Because we made about $50,000 in gains. Yeah, we probably made a bit of money off of it. Oil prices are rising high. Okay. So I definitely want to keep cash right now because I don't know whether or not interest rates are going to go up or down. But I think the likelihood is that interest rates are likely to go up. And so I don't want to get, I really don't want to get hurt. So right now we're not even holding much of a bond position. This is where I do cash and cash equivalents. And I think it actually tells us how much we make off cash and cash equivalents. Right. Does it? I think it's under interest rates. It tells us how much percent we're making off our margin. I think if you go to interest rates, brokerage, so we're making about 0.48%, so we're making almost nothing. But still, we have cash for liquidity, which is nice. So if interest rates start going up, we're going to go heavy into bonds again. But right now, I don't see opportunity in going into bonds right now. Might make sense to do a little bit of laddering. Just to help not sacrifice our returns. So in this case, 2027. Because it's an opportunity cost. Because if we keep this whole $187,000 just in cash, and if interest rates don't go up for 2 years, and we just kept cash, we could have potentially made a bit of a small return. So investing, I think the hardest thing about investing is there's always an opportunity cost. You buy a bond, you get stability and safety. Whereas with stocks, you take a bit more risk. There's always something else that you could be doing, and so that's one thing that kind of makes me a bit worried about everything. Okay, what's the current year? That'd be very helpful. 2027. So 2027 is the current year. If we look at our bond portfolio, we still have the NATO and we still have the Raymond James bond. It's currently 2027, so our Raymond bond, which is worth about $41,000, will be maturing soon. So it's currently 2027. It pays about 6%, so that's actually not that bad. I might consider buying more of the Raymond bond and averaging down and maybe actually getting a bit below our $101 cost basis. So we're looking for bonds that are somewhere near 2027 to 2030, just for some liquidity and not to sacrifice our. So this one might be good. We'll make about, yeah, it's pretty good. 5%. It's for about 1 year too. It's actually a pretty liquid bond. It'll pay us about 5%. So I'm gonna probably put like maybe 50,000 to that bond because it's gonna mature very, very soon, and it's pretty likely they're gonna pay us back. So in that case, we bought that bond. It's nice and liquid. So in this case, I'll add it to my bond ladder. So we have Noble Energy. So there's a 20. Oh, not a 20. Oh, my bad. 2028 bond, and this is known as Noble. I'll just call it Noble because I don't know how to spell energy sometimes. Noble Inc. So in this case, we have a pretty liquid bond position. And I think we're pretty much good for that. If I can find a bit more of a more liquid bond, maybe 2029, huh? 2029, here we go. Answer solved. So I'd like to buy a bit more of this too. It depends how much cash we have. We have about $136,000 in cash, so I'm gonna buy about 30,000 of this Tosh stock. I think it's Toshiba. Yeah. So I'm gonna buy about 30. Let's buy about 40 of these because it's trading about below par. That's almost about a $40,000 purchase. So that's what I was kind of aiming for. So right now we have about $96,000 in cash. So if I see a good deal in the bond market, I'll go ahead and go into it. But I wanted to help reduce my opportunity cost if interest rates stay flat because I want to make a bit of a return. So this is a Toshiba. That's 2029. So we have a 2028 Noble Inc., 2029 Toshiba, 2030 convertible Raymond bond, and a 2034 Natel convertible. So right now, I'd say that we're pretty good when it comes to our interest rate risk in this game. So I think if our interest rates were going up, we'd be pretty good. And like our cash, we're about 90 something thousand. So I'd say that we're pretty gosh dang liquid when it comes to everything. So if interest rates were to go up, we're not going to be super duper hurt. Well, as the other strategy I was doing, I was getting hurt by interest rates a lot. So we're still making income. We're making about $8,000 in income minus our tax. We're making about $6,000, and we have $50,000 maturing soon. And we have, yeah. So we have $50,000 maturing soon. So our plans on rolling that $50,000, which should be the Noble Ink. We'll roll that Noble Ink into maybe a 2029 or 2030 bond. Or maybe if I want a longer term bond. I think that would be interesting. But as the moment, I don't see good opportunity with long bonds because currently interest rates are pretty low. I'd say they're moderate levels right now, but at least we're making a return. I'm not complaining because we did the liar in position. We're making some cash flow. Are there any bonds trading more than 100? This one? No, it is not. Yes, there's no good deal, no good bonds to sell at the moment. Interest rates are staying very low for right now, which is good. Because typically, I think the better the economy doing is the better junk bonds typically do. I might just take a bit of a risk and go for like a junk bond that maybe pays like a lot. 2031. So this one's considered it's considered investment grade, which is really good. 9%. It's until 2031, so it's actually semi-liquid. I'm gonna do maybe 20,000 of this because I would like a little bit of extra income. So I'm gonna buy about 21,000 of that. So now we have about $70,000 in liquidity. So I'll add that to our little list. So we have 2031. I like to always keep a mental reminder. So in this case, we have a mental reminder of everything. So now we have a bit of a good laddering strategy. We have a 2028, which will mature soon. We have a 2029, which matures soon. For 2030, we have a 2031. So when these three mature, I can roll them back into the 2031, or I can roll them into the longer term bonds. It doesn't matter. So right now we're actually pretty liquid. So that's why I like having, and we have some cash too, just in case if interest rates do go up. We can lock into government bonds. When do the government short bonds mature? I would be curious to see that. So we see like buy the short bond, it matures in 2032. So 2032 it matures, so that matures in about 5 years. How much is it trading for? How much are we buying it for? 123. Current yield's 5% on the short bond. It's not all that great. It's technically risk-free in this case, but if we buy the long, it pays about 5.8. So the short bond is paying almost the exact same. This one matures in when? It matures in 2042, so an extra 10 years. So I don't really see like a good idea of buying governments at the moment. Maybe if rates start going up to 8%, I might consider buying some governments. But right now, I think corporate bonds are worth it. My chart, we're currently flat. Interest rates have been very boring lately. They haven't been going up. Just look how boring they've been lately. They've been really boring. Like they have, like I think the highest I've seen it was at 8%. So I think it'll be more entertaining if they start hitting the 20% more often. But I felt like that was less unrealistic because I feel like only a few times in history has Canada or US been near that high interest rates, and that was like the 1970s, 1980s during the oil embargo, and they had to find ways to like control inflation, and so that's why interest rates were so high. So if I look at probably like the so interest rates have been really boring lately. More like realistic now. So I feel like it would probably make more sense to actually start buying long bonds right now, especially if interest rates continue to be like this. So right now we know that interest rates are going up. Oh, we have one of our bonds paid back in full, so that's awesome. So right now we see that interest rates are starting to spike. So it's actually entertaining now to have a bond portfolio because interest rates are getting high, and I like that. They keep spiking. Watch the short rate. Oh, starting to spike down a little bit. Okay. So now we're going to go ahead. We're going to lock in about 50,000 into the long government. So long government pays about 7.58. So I'm going to buy about 50 of these. So now we have about $51,000 in government long bonds at about 7.5%. And so if interest rates continue to fall, we're going to make a bit of money off that transaction. But if they continue to rise, we're not going to be that bad of a deal. I'm hoping interest rates go up though, because I didn't weight my entire portfolio in long bonds. They're likely to keep tightening, I think, because of that. Easing. Okay. So now we're going to take a bit of risk. High risk right now. High reward. We're going to use leverage. We're going to buy long bonds on the government. We're going to use leverage. Why not, right? Take a little bit of extra risk. Because I think once we start hitting the millions of dollars under management, I think that's when the bond portfolio gets really interesting. So we're going to take a lot of risk. We're betting that interest rates go down sharp. And they go back up, we're in trouble because we borrowed money. Yeah, we're spiking up high because of... So now we're allowed to short sell now, which is great. But I have no intention of short selling. At least at the moment. Government long bonds, we're at 64,000. Do we have any? No, we don't have any liquidity. We just have a bit of cash left. Interesting. Yeah, the short rate just keeps falling and falling. So I know basically if it continues to fall, the long bond will fall, and the prime rate will eventually follow. Oh my gosh, look how much money we made off that. So now we're allowed to trade options, but I have no intention on doing that either because that has to do with stock. Okay, I'm going to go ahead and exit out of our bond for now because I think interest rates are pretty likely not to go lower. So right now we have about a $162,000 gain on our bond, which is pretty spectacular. And we have a loan of $243,000. So that's still pretty good. I'm going to go ahead and sell our long bond. Currently it's trading at 149. So that's still pretty good. No, it's not very good. I mean, it's very expensive. So we made about $542,000 minus our debt. So we're gonna go ahead and repay back our margin loan. I find it interesting in this game because you can play around with debt. So in that case, I basically made, I think I was at 130,000. So I think I made quite a lot of money in that case. So in this case, we have a ton of cash just to play with. So I think this is when the bond ladder strategy really starts to get fun. So do we have much bond positions left? We do. We have Natel, Raymond James, Toshiba, Corel, Noble Inc. I think they paid us back in full. So last time we had it, we had about $990,000 in cash. So it's currently 2028. And we have cash of 200,000, so we're gonna keep that cash. And I may buy up some bonds. I don't really know what to do entirely at the moment. I think it's not a good idea unless I find some very, very liquid bonds that are trading for a very good deal, but that's pretty unlikely. So we know now it's currently 2028, so we're looking for some very, very liquid ones. 2029, this one could potentially be a good deal. Maybe look for some 2030 bonds. I think that might be a little bit of a better opportunity for us. Wish there was a way to organize this. Like, this is a little bit hard to look for because I gotta squint my eyes a lot. This could potentially be a good idea. It's like it's paid about 5%, so we're at least gonna make something. And we have about a year on it, so we're making about a 5% return for 1 year. Is there any more liquid? Start looking at like the more chunkier side. I used to be so good at scanning through this stuff. 2031 still pays 5%. Let's look for a little bit more riskier junk bonds. So in this case, this one's pretty. This one pays a nice hefty amount, but it doesn't mature soon. Gateway. So this one is potentially a good junk bond. 18%. So I have to do a bit of research on this company because it's junk bond, so they're pretty unlikely to pay me back. So maybe the market is undervalued in this bond. So currently they have 50 million in free cash. A $300 bond coming due in 2031. It's currently 2028, so in about 3 years it's gonna come due. So we have to make sure they're coming in with profits, or at least they have a big line of credit. They can just borrow money from the bank in order to pay back their bond holders. They have $0 in unused bank credits. So unless they earn profits out of the wazoo, they're going bankrupt. So this is a very high risk bond for me. I think it'll be interesting though, because we'll make a ton of coupons potentially. But I think it's very unlikely we're gonna make money off this bond. So I'm gonna buy probably 100 of them. So we're gonna buy 85,000. So this is what I'm willing to lose. But we're gonna make big coupons off that bond. And if they do make a comeback, hey, they make a comeback. I'm thinking it's about time we just mess around with junk bonds and see if I can make potentially a lot or I can lose everything. 2030. Right here, 2036. Family Dollar. Are there any other junk ones I can buy that would make like a lot? Double C. This one, Dutch Alex, Repsol, it's currently 2028, so I think these bonds would be good to buy. 2030 bonds, 2033. Yeah, I think this one will be a really good Baker Hughes. So I'm going to start buying a bit more higher coupon bonds. So this one's trading for a bit of a premium. Buy 200 million of it. It's about $200,000 bet. I'll have to borrow a bit for this transaction. Yikes. I want to buy maybe just 50. I want to do 50, dude. Let's do 70 of them, I guess. 70,000. So in this case, we own some high coupon bonds, which we're taking a little bit more risk for potentially more reward. So we have our Natel, we have Raymond James for this, we have Toshiba, we have Gateway Computers, which matures in 2031. So we're gonna have to watch this like a hawk, because I'm pretty sure Gateway, this is a junk, so I'm gonna do capital junk. I think I can bold it too. No, I cannot bold on WordPad. And this matures in 2033. And this is oh, wait. Oh, no, this is Baker. So these two are junks. So I'm gonna have to watch these two like a hawk, because potentially I could make a lot of money off these junks, or I could lose a lot of money off these junk. But as you can see, the yield to maturities are so much higher, which potentially is a great idea for me. But they're considered junk, so it's pretty unlikely I'm gonna get my money back unless the company makes a giant turnaround. That's why I didn't want to put my entire money into Baker Hughes bonds. Plus, I'm pretty sure that interest rates are likely to go back up. So Baker Hughes is making a bit of a comeback lately. But no, the stock is not going up. The stock is just going up, not the actual company. But that could mean something. That could mean that the company is potentially doing better fundamentally. Therefore, they're more likely to pay me back. $2 a share in earnings. So that's about $215 million that are adding to their liquidity. So if I look into the actual company, Baker Hughes, they should have an extra $200 million just in cash. They do. So they're actually able to pay it back. They have a bit of money in their line of credit, so they can borrow money to basically pay me back. So I think as long as interest rates stay low, that way their variable loan is cheap if interest rates stay kind of flat lately. So they're pretty likely to pay me back if interest rates, I think, stay flat. Because they have a giant bank loan, which is variable. So if interest rates go up a lot, basically Baker Hughes is that's gonna degrade on their profits, and so potentially they could go bankrupt. But if interest rates stay kind of flat, I'm thinking they could survive this. Could survive bankruptcy in this game. I'm just gonna keep a ton of cash though right now. Do a bit of liquid bonds and such. So the current year, it should be 2028. Yep. Let's look for another liquid one. I want to look for something that's more likely to pay me back though. 2028, 2050. This one will be interesting, but it pays almost nothing. So they're smart management. They actually raise capital when interest rates are low. That's why I do it in a Wall Street Raider in games like that. I typically I raise capital whenever interest rates are low. See, no 2020 something. 2052, that's not a good one. 2029, here's a good one. Alcoa, 4%. So we should make about 4% return for this one. So let's go ahead, maybe buy up some Alcoa. How much liquidity do we have? We have about 114,000. So I'm gonna put about maybe 80,000. Well, let's just do 35 of these bonds. About 35k bet. So in this case, we have a little bit of cash on us right now. Alcoa, 2029. So in this case, we're looking for right here. Oh, my bad, I didn't do the date. So right now we have Alcoa, which pays us in 2029. We have some lawn bonds, but we don't have a lot of lawn bonds at the moment, which I mainly don't want to keep. So right now we have a little bit of liquidity. We have $78,000 just sitting in cash, which I have plans on deploying if I find a good deal with like long-term bonds, or if I find a good corporate bond that pays a lot. But at the moment, I'm just going to keep it in cash. So if I want to do my return, I'm just generally curious. So we started off with, so our portfolio value is currently $397,000. Right? We subtract our $100,000 start in. We got $200,000 in gains. So if we did that, divide by 100,000. we made about 2.9. If we divide that by 8, because we did it for about 8 years, we made about... So this is about our average return each year. We made about 37% off our bond portfolio every year. So that's pretty good. So eventually, if I can up my risk, I can potentially up my return, because I'm doing junk bonds, and I can potentially do much better. So we made about 37% a year on our bond portfolio. That's including capital gains, including our great coupons and everything else. So we're actually doing pretty well. So now we have some bonds coming due. We have Toshiba and Alcoa. They're coming due soon. So I should receive some nice coupons for the time being. $77,000 in cash. Okay, we don't own the individual stocks of these companies, but it'll be still kind of good to know. So Baker Hughes is still kind of worth a hold, and Gateway Computers isn't doing so hot. Okay, how was the fundamentals of this company? Are they deteriorating? $51 million in cash. Working capital I completely ignore in this game because it's not liquid at all. $0 in line of credit. I don't think they're coming back. 16 cents EPS. So we look at their outstanding shares. How many shares do they have outstanding? About 10 million. So in this case, if they're making 0.16 a share times their 10 million shares outstanding, right? They're making about 1.6 million, right? Yeah, so I'm thinking it's pretty unlikely they're gonna pay me back. So that's like a complete write-off. I'm probably gonna lose money on it unless they become extremely profitable or unless they liquidate assets. So if I look at the company, right, Gateway, they currently have 400 million in assets. So they're just staying alive because their total assets, they're not considered insolvent in this case because their total assets are 548 million. Their total liabilities are 476 million. So with their total, they have about total equity of 72 million. But like they're pretty much on the verge of being insolvent, where basically their debts may outpace their assets. So in this case, their liabilities may outpace their assets, and that's very, very likely to happen if they're unprofitable because they're gonna have to add on more and more of their liabilities. So I find that kind of interesting. Who knows? I think the company's pretty likely to go bankrupt though, but they do pay such a high coupon that I think it's worth taking a bit of speculation on it. Okay, we got our money back, right? So now we have no more 2029 bonds, so now we can get rid of Alcoa and Toshiba. So now we have a little bit of extra liquidity. So I want to put about half our money into something. Oh, shoot! Oh, I was not paying attention to this. Look at this. Oh, interest rates went up. Thank you, Bond Lantern. So in this case, okay, let's look at what the central bank thinks. Currently, they're tightening. So that is fun. So I'm gonna do about let's do 25,000 like I was saying prior. So I want to buy about let's just do about 30 of these bonds. So I'm gonna do 30 of the long bond, pays us 7.75%. So now we have about 129,000 left. So if I see a potential good deal, if interest rates go to 10, because I'll buy it maybe another 30,000. We didn't really buy exactly 30,000, did we? We bought 29,000. Close. We're gonna continue buying more and more as interest rates rise. What? Oh, subprime mortgages. Interesting. Still tightening. It's good. So I think GDP is starting to have a bit of a hit. So in this game, they think that raising interest rates might grow the economy, or they might decline the economy. Depends, but I'm pretty sure that interest rates might be going up over the short term. So I'm going to go a bit more heavy into lawn bonds, governments, and of course corporation. Would love to buy more corporate bonds right now. Hey, our bond portfolio is taking a big hit lately. But look at this, freaking Gateway Computers is paying us 21%. Still, that's very high risk. 134,000. So I want to do about $30,000 into a long. Let's look for a very long. What time is it? It is currently 2029. Okay, so now we're gonna go ahead and recall. We're looking for some 2050 bonds or something. 2053 pays us 10% a year. And it's AAA, and the market price has been hurt so much. Oh my goodness, this is probably my new favorite bond right here. Pays us 10% right now, which is still. Interest rates could go up, or they could go down. Who knows? So I'm probably gonna put about 100,000 to Roma bonds. Just because they're so discounted. Do I have to take a margin for this? Oh, I do. Gosh dang it. Yeah, no thank you. It's borrow 41,000. 139. Borrow 6,000. I'm okay with that. So we bought up a ton of Roma bonds. Right? I pronounced it wrong, my bad. But in this case, they're paying us 10% a year, and it's considered AA. And if they decide to pay us back, they're gonna have to pay us back with 100. So I'm pretty sure that this bond is going to be a very profitable investment for me and everyone. But it's a long bond, so that's the only problem. So if interest rates continue to rise, we're in a ton of trouble. So this is I'm just gonna say Roma. It's gonna pay us about 10%. So in this case, our portfolio, we're making about $35,000 in corporate bond, $2,000 in government bond interest. And after projected net income, mature in bonds of 43,000. So I'm gonna probably put that into some long government bonds. But in this case, we should be making about $38,000 after tax. We're making $52,000 now a year, so that's pretty good. That Roma bond, oh my gosh, I love the 10% interest. But as I said, interest rates could be going up. In this case, they are going up. So I'm pretty happy I did not leverage my position. Well, I used some leverage, but we're gonna be paying off our debt pretty easily because we're making about $35,000 after tax. So in this case, I'm pretty happy. And I plan on putting back my profits into buy more lawn bonds. So if we look at our calendar, wait, didn't it say on the thing, the cash flow? It says right here we have a bond maturing in $43,000 maturing soon. That'll be interesting. I'm guessing it's the Raymond James bond that's maturing soon, so that's pretty interesting. So yeah, so we should be receiving a ton of money back, which is interesting. Wait, is the Raymond James how much is the Raymond James bond trading for? $96. It's 2030, and it pays us about a 12% coupon. I'm gonna go ahead and use some leverage. We're gonna go and buy the Raymond James bond because it's trading at a bit of a low valuation right now. I'm gonna buy a bunch of it, and we're gonna get paid back 100. We just used some leverage for that because I saw it as a good opportunity because this bond is gonna be maturing at a 100. It's trading at 97, and it's gonna be coming due very soon. It's paying about 11%. So in that case, I saw it as a bit of a short-term opportunity and buying up a ton of it. It's going to hurt our cash flow in the short term, but it may be a good opportunity. maybe. After tax, maybe not. I'm kind of being lazy, not doing after tax calculations. Been mostly flat lately. Should have did maybe an after tax calculation before I took out tons and tons of money in leverage. Okay, so now interest rates are starting to fall. So our Raymond James bond is currently worth a little bit. It's still we still have a bit of a loss on it. But it'll pay us back $1. Plus, we made a bit of coupons off of it. I'm allowed to do futures now. Interesting. I never really touched futures. So in this case, we should have received. We should be receiving a large amount of cash soon. Cash flow for days. Let's go. And our borrowing cost for that margin loan should be going down. So that's potentially a great idea because interesting. RGM paid investors full at maturity. Awesome. So now we have $420,000. We have $360,000 in borrowing. We still have a ton of corporate bonds. So we actually received like a lot of money. So I'm gonna go ahead and repay back our broker. What? I did not know you could. Oh, you could borrow from broker. I thought you could change brokers. I was like, that's interesting. So in this case, we have $58,000 just sitting in cash, and we have about a giant bond portfolio where you made a lot of money off this. Amazing bond right here, the 2053. We made so much. Oh my gosh! Now we're starting to hit momentum. We're starting to hit real gains. So if interest rates continue to fall, I'm gonna go ahead and sell this. But right now we're making bank. How is our junk bond doing? Is it doing all right? Gateway computers. They're deteriorating. Yeah, not very good for us. Now we can get rid of the Raymond bond because they pay us back in full. We still have our quite high risk bond right here, but it's actually trading a little bit above from what we bought it at. So that's actually potentially a good idea. This bond is our best performer. So I want to probably. Our government bond, we made about 12,000. I want to take some profits on that. There we go. We took some profits on the lawn bond, and if interest rates continue to fall, I will go ahead and I'll go ahead and sell all that amazing corporate bond we just bought a while ago. Income tax rates were raised. Oh, that's potential. That could be potentially a bad thing. They're neutral. Yeah, so I don't know whether or not interest rates are going to be going up or down. And they're currently going down. So tax rates should be going up. I'm pretty sure it was 26% prior. Quote me if I'm wrong. But in this case, I'm pretty sure it was 26% on ordinary income. Or I'm pretty sure they raised the capital gains tax. So that could potentially hurt the investment a lot. of scares me away from doing capital gains as much, but I'm still going to be doing it. When they raise taxes, it should be hurting. When they do higher taxes, it should be able to make credit a lot more expensive. So I'm gonna go ahead and get all this bond right here. I'm gonna go ahead and get all my bonds just because I think that interest rates are likely to go back up. So we're gonna take some huge gains out of our bond portfolio. Keep some of them just for the income, because the income would just be great. So I'm gonna keep this one because it's junk. Here, let's see. Let's just do a bit of a financial review. See how well they're doing. $70 million in cash, 52 million in AR, about 300 million assets. So they're even more insolvent than they were last time we saw them. Their equity was 72 last time. It's now 40. So they're looking a little bit more insolvent every day. So I'm betting that basically, yeah, they're unprofitable. The last 2 years they've been unprofitable mostly. Yeah, and negative 1.03. So it actually might make sense to maybe not take the risk and get out of it. But then again, it's only taking up $88,000 in my portfolio, which sounds like a lot. So it might be worth the risk just to keep it, just for the amazing coupons. But we might lose 100% on that bond, which I'm not all that comfortable with. But it's a small amount of my portfolio in that bond. Baker Hughes is doing alright too. Yep. So I'm gonna go ahead and maybe just do some more liquid bonds. So now we're at about 400. We're at record cash right now. I'm gonna go ahead and aim for some more liquid bonds. I want to do more liquid bonds just because I want to grow our wealth even more. So that transaction was really good. We grew our wealth a little bit more too. Oh, I need to look at the current year, 2030. Current year. So in this case, 2033, 3 years out, we make about 6% a year. That's not bad. What if we look out to 2032? 6%. So we'll make a small profit of around maybe 3%, including the overpayment. We don't have a 2032 bond in our ladder in position. 2031, small little profit on that potentially. Let me look for a bit more higher risk bonds like junks. Where's the 10%? I saw a 10. 2034. This one pays a high coupon, which I like. So it's about 10%, and we'll keep about 10% on that. Potentially pretty good. We're paying about 5% above the par value. So in this case, we'll be receiving about almost 10% a year for about 4 years. It will help us with our longer bond. And I did notice that you can also deduct like a bit of like you get a bit of a deduction for overpaying for your bond, which I like too in this game. It's a bit of a high coupon. I'm gonna probably start aiming for some higher coupon bonds. So I have about a budget of 400,000. So let's put 90,000 to this bond. So I could probably buy 90 of them. That's about a $95,000 bet. Cool. So now we have about 396. And we also bought one for 2034. Oh, yeah, I can see why I separated this. I separated these two just because these are the two junk bonds I have in my portfolio. So we bought up a 2034 recently, which is Outback Steakhouse. Right? Yep. It's paid about 9% a year. So that could potentially be a great idea for us. And we have about 396,000. I want to keep at least 200,000 in cash, just in case if I see a good deal. So let me aim for probably. I'm not going to be doing super duper long bonds. I'm going to get rid of the Roma because we sold that bond. Let's do some junk. Just going looking for some high coupons. Triple C, Queensland Securities, 13.24%, 2035. There's a 2032, I'd like that. 2031, Gateway, so that's the potentially high risk company we have. Here's a Narjunk bond right here at 15%. Yeah, I'm probably gonna do a giant junk one for this one. 600 million. Eee! Oh gosh, I can see why they're in a little bit of trouble. 10,000. They basically they have as much assets as they do in bonds, so all their business assets are tied up. So they're gonna have to sell those for potentially a loss or a bit less than what it's worth. So in this case, this is a bit of a high risk bond. Unless they are going to receive profits out of the wazoo, I think this is not worth my time or looking into. $1.29 a share. They've been highly profitable for the last 2 years. I'm going to go ahead and limit this position to 50,000. I could potentially make a lot off this bond though. It might actually make sense to buy a lot of it. But who knows where it might go. Let's just buy out. Is it a below par bond? It is trading at 85, yeah, so it's potentially below par. How much is that? $128,000 bet. That's alright, I guess. So we're gonna go ahead and keep that junk bond until it matures. Right here, right? Yeah, so it's a 20. It's probably the last junk I'm gonna touch for a while though. So this is 2032. So we have a ton of junks coming due soon. So it may be worth it just to. So in this case, we have about $265,000 in cash. And I'll probably look for some lower quality, some higher quality junk bonds that aren't CC, because these are on all these companies are on the verge of bankruptcy. So maybe look for some Bs where they're more likely to pay you back. 2030, 2033 right here, 7%. We should also look for some just more liquid bonds in general, like some that are due 2031 right here. Yeah, let's do Nvidia. I'm gonna do 60,000, 65,000 in this company, and that's enough for buying bonds for now at least. About 65,000. So we bought Nvidia bonds, mature very soon. So this is not considered a junk. So it'll be 2031. It's known as Nvidia. So we got Nvidia Corp. So these are like the only decent credit quality companies we own. So and then we have about a ton in cash. We have about $199,000 in cash, which I'm going to use to maybe average down in our positions or buy some bonds whenever I see a good deal, because I'm pretty sure interest rates are going to rise. I'm also going to probably start doing some more convertible bonds just for a bit more of capital gains potential. So now our cash flow, we're making $41,000 a year, and then with the bond discount, we're getting 53,000, and minus that tax, we're making about 38,000. And we're making, we're going to be having about 185,000 of that coming due soon. So I'm going to use that towards rolling back into maybe some more junk. I think it'll be interesting to operate a bit of a junk bond portfolio. even though they're potentially more high risk. How are they doing? 100. Outback is doing well. What happened to Gateway? Gateway is doing pretty bad. I'm gonna up my stake in Gateway maybe. Yeah, I think Gateway, they're pretty unlikely to pay back their debt. Yeah, I think they're losing money. Yeah, they're losing money again, so they're pretty unlikely to pay me back. Yeah. They might pay me back, they might not, who knows. What's my biggest bond right now? We have $127,000 in this bond right here. And I'm pretty sure what's the credit rating on the company. It's C. So we have about $127,000 of our entire portfolio. It is very, very high risk. So we could potentially lose about $127,000. So I'm gonna play a little bit conservative. But I think that company is a lot better than Gateway. Gateway, I think, is just more likely to go bankrupt because they're losing money every year. Whereas I think Telly is actually making profits, or at least making a decent amount. Because like they're actually, yeah, but like they're pretty likely they're gonna have to sell assets. How much credit did they have? 0. So they're pretty likely to go bankrupt, or they'll have to sell off a ton of their assets. It might make sense though. They might have to restructure around their company a bit. They go. They're due in 2032, which is all right, and we should be able to receive a bit of coupon from Nvidia. And this interest rates are going to be low for a while though. Telly currently 9.89. Look at this. Oh my goodness, it's such a high coupon. What happened? What happened to your bonds? What happened to Gateway? Wow. Still trading at 89. Huh. $164,000 in cash. Oh, probably owed a bunch of taxes. Uh-oh. Yeah. Oh gosh. Yeah, Gateway's having liquidity problems, so their net profit from business operations is almost nothing. And then they have interest expenses on bank loans and interest rates on bonds. So they're having negative after cash flow. That bonds due very, very soon. Yeah, so they're pretty likely to go bankrupt. Pretty likely. What is their bond right now? Eesh. That's definitely a write-off. I'm definitely gonna lose money off that. I would sell and take a bit of a capital loss, but at the same time, don't know what could happen with them. Hopefully they issue stock and then they're able to pay off a bit of their debt. But who would want to buy stock in a near bankrupt company? CRD, paid bonds in full. So we have a little bit of liquidity left. Oh my goodness, look at gold. $2,500. So in order to pay, the credit rating is proposing to recapitalize by issuing $2 of new 50% bonds for each. Wait, what is this? 2-for-1 swap. I've never seen this in my entire life. I have never seen this in my entire life. Found that kind of interesting. Does that make them a little bit... Oh! It's another triple C. Okay, that makes me feel a little bit more confident. I'm guessing instead of having $300 million due, they just said, hey, we're gonna go bankrupt. Can we renegotiate with our creditors and such to ease the load off of us? And I'm okay with that. Average cost. Oh, my average cost went up so much. But I think they're more likely to survive this bankruptcy. It's due 2036. When was it due before? So they renegotiated the terms on their bond. That's 2036 when they mature. Interesting. Right? Big gateway. So I'm guessing they renegotiated their terms on the loan. So in that case, I think they should be more likely to pay me back. Who knows? It might make more sense to buy one of the Natel bond, maybe? No, it's trading almost near par. It's paying like nothing, too. Interest rates are low right now, which I hate, because it's not very good for me. What's the current year? 2031. Okay, let's just use some of our liquidity. No. 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 Nope. That's alright, I guess. But it's not gonna pay as much. Yeah, let's keep cash. Okay, I'll probably wait for all these bonds to mature, or at least some of them to near maturity. And then I'll probably quit the episode. Interest rates have been very, very low for a while, which I don't like. Kind of wish there was an opportunity to buy variable loans. Raise tax rates to 29, increase the... Oh gosh, capital gains have gone up. Yikes. So that's probably likely that they're going to be increasing the interest rates. Oh, they're neutral. That's going to eat me alive a little bit more. Taxes are a lot higher now, I guess, which kind of sucks. Let's look at economics. We're now paying 27% on capital gains instead of 18. It was very good when it was 18. Now it's 34. So now it probably makes more sense to aim for capital gains. I'd really like to play around with the stock market right now, because bonds are just pretty bad right now. Unless I'm doing junk, I guess. It's currently, what's the year? It's currently 2031. see good deals. Aye, this one might be good. It's technically 2031, right? We don't have that. Yeah, we don't have the video or anything else. Like, yeah, our bond portfolio is very, very small at the moment. How liquid is this company? 190. Loss, that's not very good. See what the recapitalization does. $2032, okay. So they should owe us a little bit less money, which sucks for me because I'm a bondholder. No, we have no stocks. How liquid are they now? Oh. Okay. Hey, big maturities coming up. This one. I think I L on this one, I guess. I took a capital loss. Do I owe any tax? That's the big question. Year to date. A little bit. We took an L on this bond right here. Okay, rates are finally starting to rise. It's about time. We take our L on the Gateway Computers bond. It's not ideal. No, it's gonna make a comeback. I think I'm gonna call it quits for now. At least I think this bond portfolio thing is kind of interesting, but it also gets pretty dry because we've been pretty much flat for mostly our entire time. But anyways, hope you guys enjoyed the video. Yeah, it's pretty interesting. I'm trying to manage the portfolio as much, but it's just a little bit complicated. I think it'll be a lot more interesting if I did a 50-50 stock thing, because then I'd be growing my wealth a lot faster. So this is like a little bit slower pace, which I find is interesting, but it's also kind of boring for some people. So I'm gonna call it quits for today. Thank you guys for watching. Have a good one. Bye bye.